Thank you for joining us for today's session on tax and accounting in a blockchain and crypto world. My name is Ron Quaranta, and I'm very privileged to serve as chairman of the board of the Wall Street Blockchain Alliance. The WSBA is a nonprofit trade association based here in New York City with satellite offices in London, Sydney, and soon to be Shanghai, really with a global mission to guide and promote comprehensive adoption of blockchain technology and crypto assets across global markets. Our member base is what you'd suspect as the usual suspects across financial markets, banks and brokerage firms and fintech firms. But increasingly, because of the size and scope of this ecosystem, lawyers, accounting practices, supply chain, startups, and one of the most important of these aspects and the fastest growing demographic that we have is the accounting practice. One of the partnerships we're most proud of is our partnership with AICPA and CPA.com, really working together to drive adoption, knowledge, and education for the accounting professional and understand how blockchain and crypto assets will evolve the accounting profession. I want to yield a little bit of my time to a friend and colleague in this space, Mr. Erik Aurskeson, who's the president of CPA.com, who will tell you a little bit more about what he sees for the future of blockchain for the accounting profession.
Yeah, hi. Is this on? Hi, good morning. Erik Aurskeson. I'm the president of CPA.com, but I also am part of the executive leadership team of the AICPA. The AICPA is the National Accounting Association here in America. 80% of CPAs in America are members, but it's also a global organization with offices in 23 countries, and we have over 600,000 members around the world. And we are thinking a lot about what blockchain means to the accounting profession. The partnership with the Wall Street Blockchain Alliance has been very, very important, instrumental for us over the last couple of years, because I can tell you a few years ago I'd be at events and I'd be with many of the firms, and they would say, you know what, blockchain is the end of the auditing profession. And it really couldn't be further from the truth. You heard this morning about the importance of trust, the importance of compliance, the regulatory environment increasing, and we are really thinking about framing the discussion and the opportunity for the profession, and there's just tremendous opportunities for firms to play a very valuable and critical role here in the ecosystem and really delivering trust to these systems. One quick example, maybe some of you heard about it, this VeriArt, which was putting all of the works of art around the world on a blockchain, and then someone went and registered the Mona Lisa fraudulently. So there's all kinds of permission-based blockchains, smart contracts, lots of things that need to be checked. And what the AICPA is looking at is advancing their standards and guidance. There's a standard called the SOC reports, Service Organization Control Reports. Those are the backbone of doing the internal control checking of services like payroll. And right now there's a working group looking at evolving and leveraging the Service Organization Control Reports, the SOC reports, to support the review and the assurance of smart contracts and permission-based blockchains. And these types of things will help drive adoption. Just finally, what we're really thinking a lot about is education. There's 45,000 firms in America. We're out there putting on podcasts, webinars, lots of training tools. Ron, and your team's been critical, and what I want to do now is just turn it over to this great panel and learn some. So thanks, Ron.
Great, thank you, Erik. So I will do a disservice trying to introduce you all, so I'm going to let you all spend a couple of moments introducing yourselves. Jeremy, let's start with you.
Sure. First, thank you for finding the room. I'm not sure about others, but I had a little trouble figuring this out. But with that being said, my name is Jeremy Drain. I'm the Chief Commercial Officer for a firm called Libra. Our URL is www.libra.tech. The mission of our company is to transform distributed and decentralized data into auditable information. A lot of folks think of us as middle and back office software, crypto tax software. Our customer base is funds, hedge funds, funds administrators. We have about 200 hedge funds as customers. We've got approximately 10 to 15 fund administrators as customers. We have OTC and prop desks as customers. We have crypto exchanges as customers. and we have accounting firms as customers. So thanks for joining.
Hello. Thank you. My name is Alon. I'm the CEO of Blox. I've been in the blockchain industry for 6 years. I started up as a developer, contributed code to many of the projects you guys know, like Bitcoin and Ethereum, developed my own wallet along the way. And quickly realized that in order for blockchain to really be widespread, we need a really good infrastructure and services for companies coming in and building their services and managing their assets. And Blox is a kind of an A to Z crypto asset tracking and management platform. We offer services for companies who manage crypto as an investment or raise money in crypto or have a product driven by crypto assets, and really provide them all the tools they need in order to keep track of those assets, do compliance functions, finance functions, development functions. And so we really see ourselves as kind of the gateway for them and the infrastructure for them to really build their services and operations. We have really leading companies from the industry as customers, Status, Eternity, eToro, really companies who are at the forefront of what this industry is doing and is capable of. And that's it. Blox, BLOX, it seems, .io. Thank you.
Hello, everyone. My name is Healy, and I'm a proud member of AICPA, just to plug AICPA. I'm from UI. As many of you know, we are a full, diverse professional service firm where we do have audit practice. We have what we call advisory practice. I actually sit in the advisory practice focusing on accounting and reporting. So we deal with helping our clients, whether you are an investor, an exchange, or a miner. We help you with some of the accounting policies, all the processes and controls or compliance reporting that you need to have, and all the tax, I would say, compliance issues or structuring that you need to be concerned about with respect to the cryptocurrency activities. So that's what we do, and that's where I focus my time on. Thanks.
Great, thank you all. So I'd like to start with some fundamentals. We've been hearing that blockchain will be disruptive, that blockchain will, the promise of blockchain across multiple industries. I'd like to start with you, particularly given your position at EY. Focusing on the accounting profession specifically, let's talk about the functions within the accounting profession in your mind that can be reinvented or evolved in a blockchain future.
Now, when we talk about accounting, you're talking about finance in general. I mean, certainly there are a lot of discussions about how blockchain, the technology behind the cryptos or Bitcoin being applied to, I guess, improve efficiency and increase the quality of some of these finance operation, if you will. I mean, we have a lot of discussions about how we can improve all these issues with respect to intercompany transactions. Right, that's one of the areas that we have seen a lot of interest in having discussion about implementing blockchain solution to process intercompany transactions, which, if you think about it, I mean, the whole idea is to have single source of truth, and that's what blockchain technology will allow. And if you have one single source of truth, that means there is no reconciliation that needs to happen, which for a lot of complex organizations like a financial institutions, that would save a lot of headcounts, which eventually translate into profitability. So that's where I'm seeing on that.
Jeremy or Alon, you guys want to weigh in on that a bit?
So I really see I'm a kind of a true believer in the true sense of what blockchain and crypto can do, and I definitely see the potential in revolutionizing and democratizing the financial markets, and not only just that. Supply chains is definitely one thing that we'll see, and maybe healthcare and so on. And so I love to look at crypto and blockchain as kind of the internet for the finances. And so you have various functions like compliance and accounting and taxation and so on. A lot of those will remain the same, but a lot of those pieces will also change. And so I think one of the biggest interesting thing is how do you collect data and validate the data, and how you really do it across different functions in a company, not just the finance function, but compliance and maybe development. Everyone is kind of gathered together and stuck together with this technology.
Yeah, I guess my thought on that is most audits are based on sample sets that you execute an audit, 2, 3, 4 months after the fact, and so really the thing I like about the premise of blockchain is that you can audit a complete data set in real time, and so just broadly speaking, whether or not you are an internal auditor at a large enterprise or if you're an external auditor at a big accounting firm, essentially what that means is your audit procedures, the way in which you would audit a company would be different, right? You're no longer going to throw a bunch of people and pull down some samples and then extrapolate those results across a full data set. You're actually going to have the ability to audit that full data set in real time, which means that those people can be repurposed to do other sorts of tasks. So I think at a very fundamental basis, that's where I see a majority, a lot of the value, and I think that value accrues differently inside of an accounting firm versus an enterprise.
So I want to kind of address the elephant in the room. There's not a week that goes by, and I suspect this is true for you, Eric, as well as a lot of my fellow panelists, where an accounting professional doesn't approach me and says, Ron, you guys keep talking about blockchain. You're trying to make auditors go away. You're trying to make the accounting profession go away. And one of the things we often say, and one of the matters of policy that we put forward, is that blockchain causes roles to evolve. So Jeremy, I want to stick with you for a little bit. Let's kind of dive in a bit more into the audit function itself. Is it your perspective that the audit function kind of evaporates away, or does it evolve in the wake of blockchain and crypto assets? And what are the qualitative aspects of the audit that pure technology solutions might miss? How does it evolve in the wake of all of this?
Well, I mean, of course it doesn't go away. I mean, someone's got to check the checker. I mean, at the end of the day, I think obviously the capabilities, if you just look at the individual that's going to be in the accounting profession, it's not just about being able to do math, it's about being able to read code. So, you're going to have to create a data capability inside of each individual auditor. The auditor is going to be less a function of ticking and tying, but really looking at exceptions and then being able to offer a perspective and understand why those exceptions occurred and then be able to mitigate them. So I mean, the idea that auditing goes away, I think, is just, I mean, I think it's personally kind of silly, and I think it's vastly overstated. Certainly things become more automated, things become more real-time, things become more tech-oriented, but I mean, that's like everything in your whole life. So it's just a matter of getting educated, AICPA, plugging them away again. They do a great job in that way, and I mean that's it. I mean, just get educated. The world is going to keep adapting and getting faster, and you just have to do that for yourself as an individual as well as the organizations that you work with.
I agree with Jeremy on this point. I mean, I don't think auditors are going away, even though I may be a former auditor, I may not choose that profession to be my lifelong profession, but I think the concept of auditor going away is just silly. If you look at what auditors do, right, and the activities that they are focusing on. When we talk about how blockchain enables some of these finance activity, it's no different from some of the current tools that are out there, which is automation, right? So what does it mean? It means you are capturing transactions that are routine, and when you think about that, and the kind of activities or hours that auditors are spending on those type of transactions is actually fairly low, because a lot of it has been, I would say, done through some of the technology tools to begin with. Now, I agree that it's going to change in terms of how you do it. The timing of when you're doing it may change, the whole so-called real-time auditing and stuff like that. But auditors will be needed. There are a lot of areas that auditors spend a lot of time, particularly on the judgmental area, right, where I would say a lot of the risks reside from a financial statement preparation perspective. So that's just my perspective on that.
I actually think that auditors will be the profession will become much more technological, and I think that it's like saying that everyone has a smartphone and a camera in his pocket, and there's fewer professional photographers out there. We all know it's much higher numbers, and they're much more professional in 20 or 30 years ago. I'm running a crypto company. I see our auditors, and they are a whole different level. I mean, the level of understanding of the technology and what's happening is so beyond everything they did maybe 5 or 10 years ago. It's incredible. I mean, just think about how many edge cases they need to handle. Splits in blockchains and crypto kitties and different transactions, which mean different things. I won't go there and say that they need to be programmers, but they damn need to be almost as. I mean, reading a smart contract is basically reading a statement of how monies or assets are interacting and working. And so, we're auditing our own company, and we're seeing how much effort they're putting in. It's incredible. I think, the next 10 or 20 years for auditors and accountants and the whole, even the CFO functions in companies will be so much more technological and take much higher kind of a center stage, even in terms of products. I mean, just think about it. If I have a crypto product, all of a sudden the CFO is not just my financial function; he's also maybe part-time product designer and so on. And so, I think we're on the verge of an incredible surge in what auditors and generally speaking, finance functions are doing and will do.
Thank you, everyone. So I'm going to go full-blown accounting nerd a bit, which is weird because I'm not even technically an accountant. And I'm also going to go off script, which I'm pretty sure is going to get me thrown off the stage. But I want to dive a little bit more deeply into audit and expand into some of the conversations around, will we see the evolution of the audit function into auditing of smart contracts? Will SOC 1 and SOC 2, for example, expand or change in the wake of multiple blockchains and interoperable blockchains? And I want to open that up to anyone on the panel who would be interested in talking about how deeply will the audit function be able to audit what's implemented in the blockchain world?
If I may. So just a few words about what a smart contract is and why I think, by the way, maybe SOC certificates will be less powerful in that sense. So smart contracts are basically codes, but the main difference between your usual kind of SOC certificate and the process you're going with your usual backend server or maybe front-end servers or codes and so on, they are immutable. That is that whatever is there for eternity, and that's it. And so in terms of what the smart contract does, I think we'll see great innovation, but in terms of how you can trust it once you know what it's doing, it's much easier. It doesn't change, it will never change unless some catastrophic event will happen. And so I think in that sense, you can much more trust the smart contracts than your usual code and your need to really audit it or make sure that whatever it does or says on the box is actually what's happening inside.
So we did a research project with Rutgers University where we took the current SOC to do a system audit, and we broke that down and decomposed it into pieces, and then we looked at each component of the SOC versus and how that applied to a smart contract. And what we found in that project was that some of the existing SOC out there was relevant, some of it wasn't relevant, and then there was a whole lot of question marks. And so what we kind of took away from that exercise was, the SOCs that are out there today are going to have to be changed and matured, and they're doing that now. And so that's sort of some of the hands-on learning that we've done at Libra. But I think from where I sit, what ends up happening is if you're an auditor, okay, somebody creates a financial statement, right? That financial statement is going to pull data from a lot of different data sources. It's going to be from smart contracts, it's going to be from blockchains, it's going to be from exchanges, it's going to be from pricing services, it's going to be from banks. And so really the question is where do you focus? Do you focus in applying an audit at the edge, or do you focus applying an audit at an aggregation point where all the data comes together? And I really think that, from Libra's perspective, what we do is we focus at the aggregation point in creating a service where if you pull in data from a lot of distributed and decentralized data sources, that we can validate that that information came from that data source, and then we can convert that information into audible information. For us, that's how we are attacking, supporting next generation audits, by supporting aggregation points of data, not necessarily endpoints. Being able to build audit capabilities across individual smart contracts, protocols, and all those different places is an incredibly complicated and time-consuming exercise. And for us, our customers really want us to be able to create information at an aggregation point so they can create a financial statement, and that's where we focus.
Now, in terms of auditing, obviously, given some of these advancement in the technology, I mean, we do, from a UI perspective, has a tool that we have developed. It's called Blockchain Analyzer, which allow us to audit a lot of our clients. To just step back a little bit, we do have about, I think, at least in the US, about 200 clients that are involved in some of these, I would say, trading activities. And we have been able to use the tool that we have developed in auditing some of these transactions, if you will. So to be fair, though, I mean, these technologies are emerging, and we continue to develop that tool so that we can do whatever verification that we need to do on some of these transactions. Thanks.
Great, thank you. So let's shift focus just a little bit. Let's look at the world of crypto assets broadly. It's been a particularly challenging time, price problems and market drops aside. Let's dive into crypto assets and how they're percolating through and seeping into back and middle office processing. I know many of you focus on that in particular. What are the challenges for back office and middle office processing in a world of multiple crypto assets? And Jeremy, I think you alluded to some of it from an integration perspective. How does that develop over time, and what are the challenges you're all working to solve, or you believe need to be solved in the industry?
Well, we probably share a lot of the same pain here. So first of all, you got to source your data. Okay, the reality is a lot of our customers don't know where their data is, and that kind of sounds silly, but all of a sudden there's an airdrop and you've got something and you don't even know where it is. So sourcing your data is a big problem in a decentralized and distributed world. Then once you get your data, then you've got to be able to pull it in and understand it. I mean, Stellar has 4 ticker symbols. I mean, if you're going to create a financial statement, are you going to put Stellar on there 4 times, or are you going to want to put Stellar on there once? Being able to standardize all your data so it looks and smells the same is like super complicated. Then you've got to be able to reconcile the data. How do you know that you have a complete and accurate data set? I mean, how do you know? So then you have to go through a very complicated process of reconciling that data. Then once you have that data set, then you have to process it. Well, the problem is that most of the processing tools out there, and I'm talking about current accounting tools, don't take into account the data structures. They're used to 2 decimal places. They're used to, I mean, they've never even smelled some of the data structures that come out of crypto land. And then you've got to be able to take all that information and then report it out. And each step of the way, there's just an incredible amount of complexity there. It sounds maybe somewhat trivial sometimes. And what ends up happening is, at least our thesis and why we've been funded and why I think we've had some successes, that our thesis is better to build a crypto native solution to deal with some of this complexity than try to retrofit existing. And ultimately, I think we've had some success in the market in that way.
Maybe I'll start with an example. So one of our clients is a small client, 10 million users, managing about $2 billion worth of crypto assets, right? And so their problem is this. They have 10 million users. Each user has around 10 different wallets on 10 different exchanges. So that's the user-facing. Then they have their own functions of finances, compliance, and development, and so they have connections to OTC desks and exchanges and so on. You all of a sudden realize that in order to do this kind of operations, I need to gather a team of highly expertise, people who understand blockchains, know how to operate, and actually get them to work on 10 different exchanges, 10 different blockchains, and put everything in one database in a huge scale. And so all of a sudden you realize they need to do 1 year of development even before they get to their actual product, which is another 1 year of development. And time to market obviously is incredibly tight. And so those are the kind of complexities our clients are kind of facing. And so they have two choices basically. Will I spend approximately $500,000 on building a team and then 1 year in development, or should I just go to a third party like Blox? And so it's actually prohibiting them to be compliant to actually developing products and getting licensed. So one of our clients has several different licenses in several different places, and the requirements are starting to become more complex. So keep track of all of the assets in all time. If there's a transaction above $150, you need to do a further KYC. So shoot an email or drop some kind of a flag to the compliance team. The developer need to support 10 different blockchains, and they want to add another 10 different blockchains. They have no idea how to do that. The finance team want to track of everything and do obviously risk management and all of those sort of things. And so all of a sudden you realize that in order for this industry to scale, it's not even just an accounting point of view, but it's a compliance point of view, and everyone wants to be compliant. In order for this industry to scale, they actually have to build their own infrastructure. So they're building their own banks in order to just build a product. It's unbelievable, and it's not a very efficient way. And so the data problem is huge here. Just imagine you can open a bank at a zero cost. Literally, you can open an Ethereum account, which is basically a bank, at zero cost, at a huge scale. So how do you keep track of all this? How do you normalize the data and so on and so forth? So it becomes a hurdle instead of a progress. So that's a big problem.
I'm hoping there's no bank regulators in the audience, but. Anything you want to add?
Well, I mean, comment on from a reporting perspective. I mean, you talk about some of the challenges in terms of getting the data. The things that I'm dealing with some of our clients, particularly the big exchanges, they don't even know what data they're looking for, frankly, from a reporting perspective. You know why? Because to step back in terms of the accounting challenges, the whole idea about this cryptocurrency is that it's a new asset, and I'm not sure that there are guidance that are that clear that says this is how you should be treating the new asset. And that's the issue with the standard, right? Without a clear understanding of what the guidance are, I'm not sure you actually know what you're looking in terms of the data elements that you need.
And it's not just one asset, it's thousands.
Right, so that's the issue that some of these exchanges are dealing with. If you're dealing with fair value accounting, I think that's a fairly easy accounting model. Easy in the sense that the framework itself is easy because you just have to mark the market. But if you have to deal with the asset as anything other than financial instrument where you can fair value it, that means you're dealing with potentially lower cost or market. And that means you have to track all your transaction at individual lot level, right? It's no different from what you have to do from tax perspective, right? So that's become very, very challenging. First, you have to track them and then maintain it to report subsequent sales or subsequent transactions. That's where the complexity comes into play.
Maybe I'll just sort of offer an example for everybody. So imagine you went out and you bought a Bitcoin, hopefully today, not 2 weeks ago. But imagine you did that and you pull it up and you're looking at your portfolio tool. You're using Blox or whatever you're using. And it says it's $3,500 USD. And then your auditor comes in and they're like, I don't know if it's $3,500 because, you know, ItBit over here says it's 3,200. There's this Korean exchange that says it's 3,800. You know, you bought that on CoinFloor for 3,500. What exactly do you put on your balance sheet? The other issue is, and so then all of a sudden you get into this valuation conversation, which is, most of the exchanges will use an average, a VWAP, I can't remember the VWAP term of what is a volume. Pardon me, I couldn't think of it up
volume
here.
Weighted
under
average
pressure.
Price.
So most of those, but that's not going to work for auditors. Auditors are going to basically say, no, hold on a second. That asset, you're going to need to pick a primary exchange, you're going to have to pick a secondary exchange, you're going to have to, and then all of a sudden, but the issue is exchanges go out of business all the time. So what ends up happening is if you're the CFO and you've got a book and you've got to value that thing, you've got to be able to have basically custom pricing on a per coin basis. And that's super complicated to do, much less in crypto land where the tools and that infrastructure that provides all that pricing information is really immature anyway. And so, it's not necessarily just that the rules are unclear, but it's also that the infrastructure that would provide the information that would allow the auditor to actually implement that rule is very immature at the same time.
So let's go down that rabbit hole just a little bit more. And one of the challenges that we see, given the complexity you've all outlined, given the challenge of valuation across a multi-crypto asset world, what we keep seeing and keep hearing about is this kind of galloping forward of enterprise adoption and usage of blockchain and across multiple economic sectors. How difficult will it be to surmount these challenges over time to feed that information into income statements, into balance sheets, into corporate reporting? Because there's this palpable sense that enterprise adoption across supply chain and ag and all of these other sectors, but the accounting required to make that workable from a corporate reporting perspective is just not there yet. How do we bridge that gap? Just pass it over.
Okay.
I was hoping E&Y would tell us exactly how to do that, so we would all know.
So here's what you do. I actually think there's a tremendous advancement. I mean, if you look at the market 2 years ago, there was, Libra, I think, was the only player. But I mean, there was basically very, very kind of rudimentary solutions, and now it keeps evolving very, very fast as the market needs are growing. I think that more than an accounting kind of issue, it's data issue. So I'm not sure how much the accounting side will change. Obviously, it will change because there's different edge cases. But it seems that we're trying to mold everything to existing accounting standards, but the data is the issue. How do you take data which is completely different than what you're used to getting, and how do you mold it into something that accounting GLs and whatever can actually digest? We put a lot of emphasis on the data, and I think that you really see great advancements. I think that, for example, again, I'm kind of speaking for my company, but I think that you find that a lot of the IRS, or in Israel, the kind of the Israeli IRS basically says keep your pricing the same all over the different years, and as long as you choose something which is reasonable and you can actually explain why you chose it. So, for example, coin market cap, although I'm not sure it's the golden standard we all think it is. We might accept it, but the data is the issue. How do you actually sign all of your transactions, say that's it, that's everything I know about?
But there is a subjectivity to saying some of that, and I think that's part of what makes some of the reporting problematic.
Ron, sorry, I can interject on how we think about financial reporting and accounting. So we always look at it from a perspective of what is your policy? Right, so take into consideration all the different standards that are out there, create a policy, and then focusing on how that policy is implemented to get the reporting that you need through people, process, and technology. I mean, certainly you guys are enablers from a technology perspective, but the rest are about having the right people who understand the transaction, having the right people who understand the accounting model, and then the right processes or governance in place to ensure that they are following that policy. You talk about valuation. It's a huge issue. But then if you step back and look at what people are dealing with, the type of assets that are out there, yes, crypto is unique, but every company is unique as well. And we have valuation specialists that value a company. right? So the question then is, how do you go about doing that? A lot of time you go through what we call the fair value measurement standard, which talk about if you have the same asset, use that, assuming that is observable. If it's not, you go into something similar and adjust for differences. And then you go into different cash flow modeling, right? So that's how, at least from a standard perspective, how you deal with fair value measurement. Now, if you're dealing with something that is traded, then the question is, which is the principal market, as I think Jeremy mentioned, which is very challenging, right? And if there is no principal market, you're talking about the most advantageous market, right? That's the principle. Now, how do you apply all those? I mean, it's not easy. So how do you compensate for some of these challenges? You have to deal with the governance and the processes of which, how you go about dealing with it. You talk about being reasonable. Why is that reasonable, right? Who sign off? It can't be just a staff accountant signing off on a value that may be significant to the balance sheet, right? So what are the steps that you go through? What are the different structures that you have in place to ensure that your valuation processes are, I would say, reasonable and supportable, if you will?
I also think that at the end of the day, the regulators and everyone who's kind of need to set the rules for all those things are also looking at the industry for solutions, because they don't have necessarily all the answers. And they are looking for reasonable answers they can actually adopt on a much larger scale for all the companies on particular issues. And there's a ton of edge cases. For example, if I'm selling an asset, most of crypto assets are selling against Bitcoin or Ethereum, right? And I want the fair value of that transaction. But again, if I'm selling large amounts, who says that the spot price of Bitcoin is actually the right price for this transaction, even though the trading pair is Bitcoin versus whatever? Because the Bitcoin market is not that big. If I'm selling $10 million worth of Bitcoin, I can actually move the market. And so all of those things are coming to account, and I think everyone is looking for reasonable kind of rule of thumbs. How do we deal with all those things?
Yep. I mean, in the standard itself, if you're talking about financial instruments, there are certainly block discount, block premium that you may consider it from an accounting perspective, but I mean, all these will have to be, I would say, considered in the transaction, whether that's maybe is a forced transaction or is it a normal transaction to trade at the kind of size that you're dealing with and stuff like that. So all these are very judgmental that you have to work with essentially your auditor to come with a reasonable valuation.
You've been suspiciously quiet. Anything you want to add?
No, I mean, I agree with what was said. I mean, we're a software company, right? And so I agree 100%. This is, from our perspective, a data problem. You know, we build tools, but if your data's bad, you know, it really doesn't matter what kind of tools you build. So I think fundamentally that's we would agree. I would agree 100%. We focus on the data first. You got to get very clean, rect, data complete, and then from there, you basically produce that data, and then you hand it to the CFOs, and they then have to go talk to the auditors to determine how to deal with the judgmental aspects of it, and then we then basically conform our data into reports based on what the auditors and the finance function agrees is required. So yeah, I think Alon's point is totally spot on.
Great, thank you. So we'll definitely reserve the last 10 minutes or so, give or take, for Q&A. Let's talk about taxation of crypto assets a bit. Okay. Fun times. So it's slightly clearer than it once was. I think there are still challenges. I'd be interested in your opinions on both knowledge and implementation, both from a regulatory perspective and an end user. What do I do about a tax reporting aspect? IRS has distributed some guidance. I know, I believe Eric, AICPA and CPA.com have weighed in with some guidance on taxation of crypto assets. For the panel, what more is needed? From a regulatory perspective, what needs to happen to allow this greater adoption? What are the challenges from a tax reporting and tax collecting perspective? And what are the solutions you think will be coming forward?
Okay, so just as a human, the issue that I see is that if I have a Coinbase account and I decide, you know what, I want to trade something, and Coinbase doesn't have that asset, so I'm going to move my Bitcoin over to my Bittrex account, and I'm going to make a buy on Bittrex. Coinbase treats that as a disposal, and that's a taxable event. So they're going to send you a report at the end of the year that's going to say, hey, dude, you sold that Bitcoin. And I'm going to be like, no, I didn't. I transferred it. And I took it from my left hand and I put it into my right hand. Now all of a sudden you got a piece of paper from a financial organization that says that you disposed of an asset, and you yourself are claiming that you transferred that asset. That kind of pressure that you put on the consumer is really, in my mind, just something that has to be solved. You know, there's lots of other tax issues associated with crypto, but at the end of the day, if we want mass adoption of the asset class, broadly speaking, you have to be able to easily allow the human on the other side to easily pay their taxes for the transactions for which they are in fact taxable. And that issue, to me, needs to be solved. To me, that's like one of the base issues, which I call portable cost basis, needs to be fixed. It could be fixed by the IRS basically coming in and saying, hey, every exchange, or whether or not you think you're an exchange, but every company that facilitates those transactions has to provide a 1099-B with cost basis. Maybe that's the answer. Maybe the industry comes together and solves it. Maybe the AICPA solves it. Maybe E&Y solves it. I don't know who solves it, but I think it's probably a collective answer. But at the end of the day, to me, that's the fundamental tax issue that's on the table. There's obviously enterprise use cases around taxes that need to be solved, but to me, that's what I'm waiting for. And I think once that's solved, I think you'll see a pickup of the use of and the trading of crypto by, you know, everyday, you know, Joe and Mary.
I definitely think cost base is probably one of the biggest issues we're facing, but also I think all the edge cases we have as a blockchain, right? So, you know, airdrop. I mean, I know a lot of people who got airdrops or forks and so and whatnot, and they don't want those assets. They don't want to hold them. They don't want to pay taxes on them. But you know, try to convince the IRS, you know, you got something and you don't want it, and so. And by the way, the IRSs of the world were the first ones to actually issue some kind of statement saying, you know, do that, and we'll consider crypto as such. But I think there's a lot of edge cases and a lot of kind of, at the end of the day, you're going to your CPA and say, well, you know, this is the position we're taking, and this is why. And it's very, very difficult to, you know, to get to a point where, you know, the IRS actually understands what you're saying, and there's a lot of risk for the early adopters because all of us at the end of the day are taking tax positions, and that can sum up to a lot of money. But definitely, if we can solve the cost basis issue, and then obviously, again, it's a data issue, so you need to gather all the data in order to understand what's the big picture and what the different positions you can take. I think we'll be in a much better place. And again, the IRS is studying this whole thing as we do, and so hopefully none of us will be in harm's way. But my guess is we will. So I mean, yeah, it's a interesting topic.
Ron, I'm not sure I want to comment on the tax side because I'm struggling with the accounting side, let alone going into that area. So, but I do know that we do have a lot of tax experts that spend a lot of time on helping our clients deal with some of these issues, particularly the taxation as a result of issuing some of these tokens where some of them become taxable just by virtue of you issuing it. So it becomes a huge issue for our clients.
So, no, go ahead. If I can just, you know, bring to the stage an anecdote, right? So you have a CryptoKitty, right? Perfect, you bought a CryptoKitty. Then that CryptoKitty all of a sudden has several different child CryptoKitties. So now try to explain to the IRS why you have a whole family of CryptoKitties. They might be worth tens of thousands of dollars. And, you know, that's a weird conversation to have with the guy who can put you in jail. And so, you know, that's the kind of thing we're living in.
Can you, I just want to make, so is the audience comfortable with keys? Do you want to just give them a really 10-second definition?
What CryptoKitties are?
Yeah, just
wow.
I told you this was going deep.
Right. So CryptoKitties, if we break it down, is if you're looking at crypto assets are fungible, right? So you can 1% of one crypto asset is exactly the same as the other type of crypto asset. It's completely fungible. Everything is fine. So CryptoKitties was kind of the first attempt to do non-fungible crypto asset. What it means is you have one CryptoKitty, and that one CryptoKitty is unique, and that how things get really, really crazy and weird. So a CryptoKitty is an actual kitty with a DNA. You can merge two CryptoKitties, and they give birth to a third CryptoKitty, which has a different DNA than both of those CryptoKitties. And because they are unique, they have a value as collectibles, right? But again, this is how it happens. Two people meet in the street. Those CryptoKitties do their business, and a new CryptoKitty is born, which can be worth 10 cents and can be worth $1 million, depending on its collectible value. And everything happens on the blockchain. Everything happens automatically and is governed by all the laws of the smart contract, which was the first kind of CryptoKitty smart contract. And by the way, that smart contract, the DNA part of it, is not auditable because nobody released its code. So there's speculation of what it means, but there's no open source code. Maybe that's changed from last time I checked. But so you basically, mating two CryptoKitties could win $1 million ticket. Nobody knows how it works because the open source product is not there. And again, try to explain the IRS why you have $1 million CryptoKitty.
So thank you, and I'm pretty sure the audience absolutely hates us now, but it was a good definition, thank you. So I want to start wrapping up real quickly. The final question that I want to put forward is, and it's a question we get asked a lot. I know, Eric, it's a question you get asked a lot, and would love your perspective as well, but what's your advice to accounting professionals, tax professionals, across the landscape of different industry verticals and on behalf of their customers and their firms about getting involved in the blockchain and crypto world? There are still so many of them that haven't taken that first step and are now running into a wall of, oh my God, I've got a customer who made $1 million in Bitcoin and I just don't know what to do, or I'm supposed to audit a blockchain smart contract and I don't even know what that means. I had an accountant say BitBlock to me at one point. What's your advice about getting involved? What's the best way to approach it? And Eric, if you wanted to weigh in for a minute, that'd be great as well.
Well, my brother once called it chain link. He's like, what are you doing in chain link? My advice, like anything else, is get educated. It's no different than when, you get a new iPhone and you're trying to figure it out. There's lots of great places where you can get education. AICPA, Consensus out of Brooklyn does a fabulous job in terms of providing free education. But at the end of the day, I kind of view the world in two components. You sort of have enterprise blockchain use cases, and then you have crypto. And that's not a fair because one begets the other, and just sort of that's a mental model for myself. If you're an accountant and you've got a book of business where you have a whole bunch of enterprise customers that are, say, suppliers for Walmart, well, yeah, you better get on board because Walmart's going to roll out an enterprise chain that's going to that you're going to have to get on board with using that system if you're going to supply them. And so you have to understand what that stack is and what it means. And hey, we're not going to do sampling anymore. We're going to take a full set. Well, what does that actually mean? When do we do it? You just got to figure out what that means for your audit plan. And then the other side is on the crypto side. If your customers are buying and selling crypto assets in any way, shape, or form, you got to figure out what the big gaps are, in terms of valuation, existence, all of those types of issues, and get smart. And so my advice, like anything else, is like just get educated, and that's really no different from anything else that you would do if you walked into a new job or if you got a new iPhone.
Don't wait for it to happen to you, right?
Yeah.
I think that every so often there comes a technology which truly can revolutionize the world, and there's very few people that can actually be part of it, and even less that actually can drive that change. And so, in that sense, I really think we are the lucky ones. I mean, just imagine if you can go back to the the early days of the PC or the early days of the internet and really be part of that change. That is tremendous kind of opportunity, and I think that blockchain and crypto really puts forward the finance side of the world in the forefront of technology, which is not something that happens often. And so everything you said, but I think that just jump in. People who will do that well will be very, very successful and will get a chance to be part of hopefully a great revolution. And so that's something I say everyone. My friends told me that 4 years ago that Bitcoin was funny money. Well, no, nobody's laughing now. So that's just jump in and start doing and getting involved.
From my perspective, though, I think the recognition that Bitcoin and blockchain technology is not going away. In fact, is growing, and the application is continuing to be growing at a rapid pace. We got to accept the fact that this is not going away, right? That's something that I'm struggling because I'm coming from the perspective of an accountant, someone that can help our clients deal with some of these issues. And I look at some of the regulators out there and say, what are you guys doing, frankly, or the Standard Setter? I think AICPA is taking a lead on a lot of different areas, particularly on the broker-dealer side, where they're focusing on a lot of the issues that our clients are dealing with, right? But then if you go to the FASB or the ISB, what are they doing? At this point, I think they still think that this is not a relevant topic for them to take out. So, which is kind of strange given the fact that we see, 2,000 people here that are excited about Bitcoin and the blockchain technology. So that's what I would say for those folks that are not believer. You got to start believing in this. Yep. Thanks.
Eric, did you want to add anything from the CPA perspective? Okay, perfect. We do have a little bit of time. Any questions from the audience? Yes, ma'am. Yes.
Hi, guys. B from Circle. I have a question. If I'm a traditional trading desk or a traditional asset manager, and I have both trading like normal equities and bonds and also crypto, how easy is it to integrate your products into my existing auditing and accounting platforms? Or is it two totally separate things and we need to go a little further?
Yeah, I think I would probably tend to lean to the second. They're two totally separate. Insofar as so think of it as a linear information chain, right? What ends up happening is if you're trading traditional assets, you're going to get very clean data, very far down down the chain, right? But if you're dealing in crypto, you actually have to go all the way back to the beginning of sourcing and cleaning that data, and then as a consequence, and then take it all the way through. And what we have found is that if you try to take your existing tool sets and smush crypto into it, it simply doesn't work. Just an example would be when you trade crypto to crypto, your fee is paid in crypto. Okay, so what that means is that you have to dispose of an asset to pay a fee. Well, if you do that, then the proper accounting is to run that fee through the P&L. But in the regular world, if you do a transaction and your fee is in fiat, you take that fee and you add it to your purchase price, and that's what creates your cost basis. And so what ends up happening is you got a whole bunch of accounting suites out there that you try to ram crypto into, and all of a sudden they don't necessarily work because crypto is just that 1 degree difference, and that 1 degree difference is sufficient enough that it makes the tool irrelevant. And so net, what we find is if you trade existing stuff, I'm sure you got great software and keep happy days. But if you trade crypto, almost all of those use cases from collecting it to reporting have enough sufficient difference that you should end up buying something that is native to the asset class itself. I don't know. Do you find the same?
I totally agree. I think another layer of complexity will be scale. So obviously, Circle. once you're talking about hundreds of thousands of transactions, maybe a day, you're talking a whole different scale, and the aggregation of data it becomes really important because it's not just one wallet. And if something missing, I can always go back and maybe try to fix the data issue. Because if you're missing a wallet, you can actually miss a wallet, and that's it. You will never know about it because they're completely separated. And so we put a lot of emphasis, and especially in blockchains like Bitcoin, which are much more complicated in that sense than Ethereum, and all the and generally speaking, the whole structure of wallets inside services like Ledger or Trezor or even BitGo, then we put a lot of emphasis in making sure that, first of all, you do not miss anything, and then we have enough flexibility that if you do need to go back and correct something, at least you have a whole complete data set. And then you have the raw data of everything that's happening. You have the layer of data that you, for example, put in, marking different transactions and as different just categories. But you also always have that 10% that you can always go back and customize. Might it be the pricing, might it be the consideration of the specific transaction and so on. Even on-chain transactions usually can be interpreted in different stages, different types. And so that's the main thing. We put a lot of emphasis on connectivity. So we have a web interface, but we also have the API interface that basically means that you can connect it to your existing trading desk or consume it via our web interface, or actually different departments can do different things depending on their convenience.
I think we have time for one more question.
Yeah. Hi, my name is Rama, and if I can just shift a little bit away from the Wall Street kind of focus to the startup entrepreneurial area, which I represent, and given your experience, and from an auditing perspective, what advice would you give your clients to keep in mind, the top 3 or 4 things when they are in the world of issuing, let's say, security tokens or implementing a blockchain-based end-use solution?
I'll just be real tactical in answering that question, which is make sure you have the right wallet structure. Okay, let me just take a step back. We have had a lot of conversations with ICOs, okay? And here's how that conversation goes. Hey, I raised a lot of money. Okay, that's great. And it's all in this wallet. And from this wallet, we bought lunch, we paid our people, we invested it, we paid bounties. And it's like, dude, just like you have a chart of accounts, you should have a wallet structure where you keep things separate, certain transactions occur in certain wallets and so forth. And so my advice to you, or to any startup, is create a wallet structure that allows you, where you have very specific types of transactions that occur in very specific wallets. Don't commingle, and be very vigilant about using the same business process flows in terms of what goes into a wallet and what goes out. Because if you come to an auditor, and what we've seen, and we deal, accounting firms use our software, the accounting firms are like, we can't make heads or tails of these transactions, because you see a wallet ID, you see a blockchain ID on one side and on another side, and it's like, where the heck did they go? Were they internal transfers? Were they external? Were they, what were they? So my advice, just broadly speaking and very tactically speaking, is create a wallet structure, talk to your auditor or your finance function, make sure that they agree, like, oh yes, that's very logical, I would be able to understand it, and then follow your transactional flows religiously.
All right, ladies and gentlemen, please join me in thanking our panel.
Thank you very much.